Welcome to TradeTheNBI.com. This is Jones. Report is for the 22nd of February. Well, yesterday, not a surprise, we came right to that 76, supported right off it, moved back above the ABM magenta right there, and touched the ABM yellow. There was some prior weakness based on what NVIDIA was going to do, and NVIDIA did perform very well. And their guidance suggests that, the bond market has been way wrong, is what it really suggested. And you can see we had like zero short activity from the MBI white. So there's been no change, even though we had some softness there. We weren't expecting much more than just a little play around, particularly since we didn't have a dip below the red line here from an ES standpoint. And you can see the complete collapse of shorts from within that setup, and a strong crossover of DOC green here means that the rally continues and new highs should be expected. Likewise, from an NQ standpoint, it had already been weaker and supported nicely with that support, and that pretty much satisfies that situation. And with what we saw from NVIDIA, you can see rates continuing to rise, and then the Fed FOMC minutes suggesting, obviously, if oil continues to make its move, they're not going to be anywhere near their inflation targets, and that is going to mean that what we were talking about the other day, a surprise to the upside for rates potentially has a greater preponderance now than any rate cut going in through at least to the end of the year. So that kind of threw a monkey wrench in the whole bond market idea that, everything was going to start easing. And of course, when many people would say the rally was the idea that, things were going to soften, but I think it's more about the inflation and just absorbing that devaluation of the dollar construct. And here we have oil not making a new high yet, but still at the higher range. And if it breaks past the 80s and gets into that mid 80 range, then I think you can expect that inflation is going to continue to rise. The Fed may do nothing, but they're going to be pressured to have to do something because that's going to accelerate inflation. Euro is still ridiculous and out of range with the zone, particularly given the fact that you're not going to be seeing any rate cuts from the U.S. side, and there's no way the ECB is going to catch up. So is this stupid? Absolutely. But that will change because as soon as oil starts to peak more, it's really going to drive the euro into a tailspin because there's no economic growth whatsoever taking place in the eurozone. And now they're talking about new sanctions with aluminum and that on Russia, and then that's only going to exacerbate things further, particularly as we've seen Germany stall because of the whole trade and oil situation. So that is definitely going to be a boon for gold in that aspect, and I would also expect that cryptos will also benefit from this construct because it suggests that inflation is no way under control and not even a serious attempt to sustain it at this particular point. They're just hoping that the elevated rates will just cool things to some degree, but that doesn't appear to be the case at this particular stage, in which case you could get some wild moves out of crypto as a counterbalance to that effect. And you can see here from pre-market, nothing but skyrocket. And that was pretty clean from a move above the 23%, magenta leading that pretty much the whole way. Cyan went under red early on, even before the breakout move. And so it's all pretty congruent and clean, nothing out of the ordinary. You took out some weak hands with the little short move, which is exactly what the markets love to do. And you can see it here. So much of the day was blah. And then as soon as post-market earnings report, boom, it went straight to the moon. And you can see that jump to the moon is continuing itself here, even in post-market, is going to be for a pretty exciting setup. Now, positive extremes, yes, definitely want to start marking those. 50-40 is definitely one of them, but again, you're not going to see any change in that aspect until there's some alteration from a reading standpoint. And at this particular stage, we don't have that. There's really very little short activity whatsoever. So this is all just bulls, and how much free capital is lying around, which I would suspect there's plenty because a lot of it has not gone into the bond market. And unless there's a significant move in bonds with rates increasing, I think the market is still, again, it's the only trade in town at this particular stage. So that's the long and the short of it. Anything relevant, I will put it on the Skype chat. Have a good one. Trade well.